Hey, what's up, everybody? It's Thursday, July 15th. They're printing money. They're printing money. Yeah, the numbers just came out. Just checked out the numbers from the Fed's weekly release. Reserve balances, $3.944 trillion. That is just a smidgen below the all-time high. About 2 months ago, I think the all-time high was 3.95 trillion. So, in the last 2 weeks, reserves in the banking system have built up over $400 billion. They're printing money. They're printing money. And the market's going down. Now, more importantly, I guess, we're going to see, remember the banking data that is released every Friday, that's usually 1 week behind the Fed's release that I just mentioned right there. And, you know, in that last week's bank data, and I talked about this, there was a big increase in loans because that happened in the week when we had a record drop in reserve balances, right? I explained all this because there's a lot of misinformation and misunderstanding about this. People think like when deposits go in, the bank lends it out. It's exactly the opposite. So in the week that saw the biggest 1 week decline in bank reserves, all right, cash, we saw the biggest increase in loans in 4 months. But now in the last 2 weeks, reserves, cash, has increased by 400 billion, almost $500 billion. I mean, it's unbelievable. Unbelievable. And now what we're going to see in the banking data, most likely, is a slowdown once again in loan growth. All right, so, you know, this is a little constricting for the economy. You know, when banks have to kind of slow down. And I explained all this, you know, cash is an asset. Banks have to have a certain amount of capital for all their assets. When you get this huge dump of cash, of reserves, banks tend to have to slow down the growth of other assets on their balance sheet, and loans being very important. All right? So we're going to probably see this in the data. Again, tell your friends, tell your colleagues when they say, oh, you know, they're going to lend out the money. No, it doesn't work like that. It doesn't work like that. It's actually the opposite of the way people normally think they understand it. So we have that going on. There was also some data out today. What was it? I forget if it was like industrial production or one of those kind of numbers. Slowest growth since last December 2020, or maybe it was even the slowest since November. So this was, and it's not a surprise to me. And the reason is I've been telling you that the fiscal flows have been slowing down, and you know that drives everything. I keep saying that. I mean, I just keep repeating that. You should understand this by now. But some new news: 15 billion. In those child tax payments went out today. Actually, I saw from yesterday's data, I think partially some of that already went out yesterday. There was like a 5.9 billion IRS tax refund. Now those child tax credits, they're going to come under, if you're following this in the daily treasury statement, they're going to come under the line item of IRS individual tax refunds. Okay, there was 5.9 billion yesterday. Yesterday was a big flow day. All right, we had 41.2 billion in spending in flows yesterday. That's big because we've been averaging about 29 billion over, you know, the 10-day average is about 29 billion per day. We had a 41 billion. However, that included a 21 billion Social Security payment, right? There's only like 4 of those every month. So if you subtract that out, the number was really more like 20 billion for the day. And if you take out that child tax credit payment, I mean, then it was really like a $14 billion day, which is really, really low. But luckily now we're going to have those child tax payments, but it's, you know, it's once every month. So I mean, I don't know. We're going to see. I'll see how it affects the average of the daily flows. Let me just say this: it's definitely beneficial. All right, it's going to help slow down or maybe even arrest the rate of deceleration in these daily flows. And again, I'm just going to tell you, the daily flows are everything, man. They're everything. All right. I want to talk a little bit about gold, because gold has been acting somewhat differently from how it normally behaves. Okay, we've had a pretty strong dollar like today, the last couple of days, and gold has been holding on to its gains. We saw the stock market coming off, which is usually indicative of, you know, an economic slowdown, or, you know, some people might say disinflation or whatever. Gold has been holding on to its gains. Now, I don't know if this has anything to do with the Basel III. You know, I've talked about Basel III and its effect on gold, and I don't really know, to be honest with you. And I don't think anybody really knows. You know, supposedly gold is now a tier 1 asset, so it makes it kind of like treasuries or cash. In the past, and I think this for me, it falls into these kind of nut job conspiracy theories, but, you know, we've been hearing for years and years and years how the banks have been suppressing the price of gold. On the one hand, I could kind of see the mechanism of how that works, because the banks, up until recently, and at least up until these Basel regulations, most of the gold they owned was classified as unallocated gold. In other words, say you went to the bank and you bought 100 ounces of gold, they'll mark it down in their book in your account. Yeah, you got 100 ounces of gold, but they might only really have 10 ounces of physical gold to cover it. You know, and they'll just issue a certificate to you like, yeah, you own 100 ounces of gold, but they don't have that. So essentially, and that's how the banks operated for a long, long time. So essentially the banks were, you know, short physical gold. So it would make sense to me anyway that they would use the paper market, the futures market or whatever, derivatives market, to keep the gold price from rising that quickly, because they're always basically short based on the fact that most of their gold positions are unallocated gold. All right. But now that unallocated gold position has become a lot more expensive, costly for the banks to maintain based on the new rules in Basel III. Okay, they have to kind of capitalize that or back that with 85% cash backing. So if that means, and also point number 2, if gold, physical gold, is a tier 1 asset like a treasury, I mean, it doesn't make a lot of sense for them to keep the price down. I mean, that, you know, tier 1 asset is a very, very important asset. And so that's one way to look at it. I'm not saying that's what's going on, but that would be an explanation, I think, for a slow and gradual long-term rise in gold. This adjustment in the regulatory treatment of gold. And I'm just saying that because it's been acting a little bit uncharacteristic lately, in the fact that normally a day when you have stocks down hard, and, you know, even the other day when we saw rates spike up on, you know, some comments by some Fed official, that would be a day that you'd see a pretty sharp sell-off in gold. That didn't happen. And it didn't happen when the dollar strengthened either. So, you know, I don't like to say, you know, 1 or 2 or 3 days, suddenly the nature of the beast, the nature of the game has changed. I'm not going to go as far as to say that. But let me put it this way. I'm paying attention to it. I'm paying attention to this uncharacteristic behavior. And maybe it's saying something. I don't know. we'll see. Okay, so basically that's it. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. I'm the only one that has an applied approach to MMT. They're printing money. 400 billion in reserve additions in the last 2 weeks. You don't hear anyone talking about that. You only get this information from me. Bye.